all came back to the discussion?
Yes, sir.
Right. So after multiplying this one here, 600,000 by point 909, what would be the answer? 545,000, 545,400.
Yes.
Yeah. Then next one, 0.826 into 600, sorry, 900,000. What would be the answer?
743,400.
700. Next one, 200,000 into 0.751.
150,200.
153.
200. 50.
50,200.
200.
Okay. Next one, 100,000 is 68,300.
62,100.
Yes, 56,400.
400.
Right. If we take this total, is the present value of cash inflows. Yeah, what is the total?
$16,25,800.
Yeah, what is that? 16 lakh.
25,800.
Is that correct?
Yes.
Okay. Oh, that's why 1,625,800, right?
Yes.
Yeah. Then NPV, so how to obtain NPV equal present value of cash inflows? Yes, 16 million to 625,800 minus 15 lakh or 1.5 million. Yeah, then NPV is
125,800.
125,800. That is positive, right? Similarly, you can do the same thing for project B as well, right? What is the answer for project B? Project B. Here, project B here. Similar amount, no? 400,000 each. Am I correct? So how to obtain it? Right? If you ignore this part, so again you can use the same thing. One here, discount factor under 10%. Then here 0.909, 0.826, 0.751, 0.683, 0.621, right? 0.564. Present value. This is similar amount. Negative 1.5 million. So if we multiply this by 400,000 into 0.909,
363, 600.
600. Next one,
So 363. 300.
okay. Next one,
330, 400. 300 and 400. $273, 200. 284 to 400. Sorry, sir. 248. No, sir. Previous one. 248, 400.
okay. Last one,
225, 600.
right. Then if we take the total,
1,000,007.
NPV of project B, what is the answer?
NPV is 241, 600.
Not NPV, present value of cash inflows. This total, except this part.
1,074, 100 and 600.
Is that?
No,
That
no,
is
sir.
wrong.
1,007,461. Okay, sir.
Okay, then that is mean, so that is important to now you will be the direct or the responsible person for different organization in future or sometime up to now you will you may that mean work as director administrative officer, right? Then it is better to say what is that amount, right? Then as mentioned here you can say 1,741,600 or otherwise 17,41,600. So it is important to say, right? So now you know that the accounting and finance for manager as subject you already completed them, right? Then you should be able to read it 1,741,600, right? Otherwise 17,41,600, right? Okay. Uh, right. What would be the answer? 241,600. No, I'm agreeing. Again, positive. Right? You can do the same thing for project B. Now, if we assume that in this case you are given only project two projects here, A and B. So, as per the A, your answer NPV is 125. Now, this is 241. So, what is the decision? What is the decision here? If we assume that you have in only two projects, A and B, yes, project yes, B is better when comparing project A because project B has highest positive NPV, right? In that way, you have to uh, write a sentence, right? Is it okay? Is it okay, doctors? If you have 3 projects, you have to do the same thing again and again compare 3. Right? Is it okay?
Okay, sir.
Right. Now,
Okay,
if you
sir.
want to provide profitability index, another one is a profitability index, right? So, if I move to here, profitability index, profitability index. So, how to calculate? Profitability index equal to present value of cash inflows over present value of cash outflows, so the initial investment, right? So here in this case project A, now profitability index of project A, so how to calculate? Present value of cash inflows here, 1,625,800 over initial investment or the present value of cash outflows is 15 lakh or 1.5 million, right? So then you can obtain answer. Tell me the answer. Tell me the answer. Doctors. Yeah. Tell me the answer. So how to? Yes, we have divide.
1.08.
1.08. 1088. Okay. Then if you go to the project B, so profitability index equal here 17 lakh 41,600 over again 15 lakh. What is the answer?
1.16.
1.16. Now what is the decision? Decision. So if you have only one project, if you want to choose, right, only one project, you have to take the highest profitability index project, right? So that is 1.61. That is project B is better. B is better based on that, right? It has higher profitability index. Then yes, you can see profitability index of A greater than profitability index of B. Sorry, B is greater than A. So then B is better, right? If you are having number of projects and if you are having enough resources to invest or funds to invest, you can accept if profitability index greater than 1 or equal to 0, so then accept project, but subject to the available capital, right? Available capital. So for example, here we have 5 projects, right? Yes, out of 5, so based on the initial investment requirement, so we can select 2 or more project, right? Or not only one. That is depend on our limited capital, right? Then the payback period. How to calculate the payback period? So in order to calculate the payback period of each project, so how to do? So have to prepare a separate table for that. You know that table. So how to prepare the payback period? So if I take only one, then here you are having cash flows after tax, right? Cash flows after tax should be here. Now here if you take project A, right, in order to calculate the payback period, now initial investment that is right, initial investment sorry, 15 lakh. This is the initial investment, then the recovery and balance. Recovery, balance. Now within the first year no recovery, therefore balance is this one, same amount, right? Then year one, you know that amount is 600,000. So we are not going to discount under the payback period. Now we are going to get the payback period. That is a discount. Yeah, that is not a discounted payback period. Payback period just consider as the traditional method, right? Year one, recovery of 600, right? So then 600,000. So after recovering 600,000 from 15, remain 900,000 negative. So year 3, year 2. So we can recover again, yeah, 900,000. 900,000. Right? Then the balance is 0. Right? 0. Therefore, what is the payback period? Payback period of this project A, payback period of project A is 2 years. Within 2 years, we can recover our initial investment. That is the payback period. So if we go to the same calculation for project project B, how to do that? Right? Project B, initial investment, again same, 15 lakh, no recovery. Project year 0, year 1, 400,000, right? Each year 400,000, recover 400,000, balance 1.1 million or 11 lakh. Right, year 2, again 400,000, balance is after reducing 400,000 from 1,100,000, so answer is 700,000 negative. Year 3, again 400,000, we can recover, and the balance is 300,000. Right, in the year 4, we can recover 400,000. Now this is the line where we need to stop our process, right? Why? Here we have to recover, in this case 300,000, but we can recover in the next year more than that. Then that is the point where we need to draw this line, right? Then then the payback period is 3 years plus 3 years plus, then we have to recover 300,000 from 400,000 of next year cash flows. So multiply this by 12 in order to convert them into month. So what is the answer? 3 years,
9 months.
3, yeah, 3 years and 9 months. Right? 3 years and 9 months. Right? The previous previous one 2 years. Yeah, if we go to the third one, so again we can do the same thing within 3 years, right? Again 3 years, no? 15 lakh we can recover within 3 years. And payback period is 3 years. Then if we take the payback period of A, B and C, right? Project A, project B and project C. What would be the answer? This is 2 years. This is 3 years and 9 months. This is 3 years. Then you have to select the lowest NPV. Lowest payback period. What is the lowest payback period? Project A is better. Project A is better as per the payback period method. What is that reason? Because within shorter period we can recover our initial investment, right? Initial investment. So you know the weakness of this payback period method. It considers only up to payback period, right? So after that there is no considerations about the cash flows, right? Cash flows over the payback period. Okay, is it clear for you? In your examination, so you can answer only for payback period, then the NPV and profitability index, right? Is it okay, doctors?
Okay, sir.
Right. Then you should be able to select the relevant present value factors, right? Right. There are a number of examples here, so you can practice before coming into the examination, right? Yeah, similar type of questions we discussed. Now, next one. This is regarding the financial statement analytical technique. Then the ratio analysis. Here, now it is important to see whether you are having previous year and next year, or this year and the previous year, right? So normally in public financial statement, I already uploaded number of financial statement, right? So I think you have that. So at that time, normally latest year here, then the previous year here, right? Therefore, if I ask, so whether we have increment or the decrease in this particular ratio, so you have to be careful with this particular year, right? In your examination, most probably latest one under the left hand side and the old one under the right hand side. So carefully read it, right? That is also important. Now, if I want to prepare the if you want to prepare gross profit ratio, here gross profit for both previous year and this year. Now in this case, this is differ, right? So consider the given one. Consider 25, this is the latest one, this is the old one, right? Always think about the date, right? Year. Now if you want to compute the gross profit ratio, GP ratio, gross profit ratio, then sales over gross profit into 100, right? Here in this case for 2024, so how to obtain gross profit ratio is 110 over sales is 200 into 100, answer is 55%. Am I correct, doctors? If you go to here, gross profit ratio 2025, then 150, that is gross profit, and sales is 290 into 100. So what would be the answer? Doctors, please tell me your answers. Is that correct? Is that 51.7? Is that correct? Doctors, can you hear me well?
Yes, sir.
Right. So if you want to calculate inventory turnover ratio, how to calculate? Inventory turnover ratio. So how to calculate? Cost of goods sold. Cost of goods sold divided by average inventory. Cost of goods sold, it is given. It is the cost of goods sold. Right? Cost of goods sold here. Right? The cost of goods sold is obtained by reducing this particular closing inventory. Closing inventory, right? And this answer is 90. In this case, answer is 140. This is the cost of goods sold, right? Then, if you want to take this one, cost of goods sold of year 2024, that is 90, right? 90 divided by average stocks, opening inventory, that is 14, right? Opening inventory, that is 14. Right? That is 14. 14 closing inventory, that is 12. Then 14 plus, then average stocks, average inventory or stocks is this much, that is 13. Now, am I correct? Then you have divide this by 30. Then 90 divided by 30. Is that correct? Yeah, 6.9, right? 6.9 times. Normally indicate inventory turnover ratio in times, right? Varagana question. So if you move to the year 2025, then again 140 divided by average inventory. So you can obtain average opening inventory, your opening inventory, and the closing inventory, that is this much, right? Then average you can obtain, that is again directly you can take, otherwise you can write it as just 20 divided by 2. Answer is 140 divided by 16. No? Am I correct? 8.75.
Yes, sir.
Yeah, 8.75. So what can you say here? If you think about the profitability, we can see decrease, no? Gross profit decrease now. Previous year 55, now 51%. So decrease here. However, if you go to the turnover ratio, previously 6.9, now 8.75 times. So if this value is higher, that is better than the lower, right? This means yeah, within 1 year we can turn our sales inventory into sales by 6.9 times. So in year 2025, it already increased up to 8.75 times per year. And then the second, the year 2025, we can see a good efficiency in inventory conversion times, right? Likewise, we can calculate different ratios, right? Not only that, now if you want to calculate the current assets ratio, so how to calculate current asset ratio, right? Current asset ratio equal current asset ratio, current ratio, current ratio, current ratio equal current assets over current liabilities. If we go to 2025, current assets, this is the current assets, right? Current assets, it includes these 5, the total is here. And this is the current assets. Total of the current assets is here. Then the next year here. So how to calculate current asset here? The current liabilities also. Current liabilities here. Current liabilities. Under the current liability, we have, in this case, we have only 2. The total is here 80 and 46. So how to calculate the current assets ratio for year 2025? Current asset is 200, current liability is 80. So yes, answer is 2.5. 2.5. If you go to the year 2025, then current asset is 110. Then current liability is 46. What is the answer? 2.39.
39.
That is somewhat closer, but we can see some declining, no? Yeah, 2.5 decline to 3.39. Then there may be some deduction in.
120.
Sorry?
And current assets is 320 in 2025.
What is that?
That's right.
Sorry. Yeah, 320. Very sorry, yeah. 300. Okay. Yeah, this one also wrong, no? 166.
That's right. 160.
Oh, 6, right? Okay. Tell me the answer. Correct answer. Yeah. 320 divided by 166. That is 1.9 or something.
1.92.
92. So we can see previous year 2.5. Yeah. Then what is the idea behind that? Yeah. Current ratio. That is the liquidity reduced to 1.92 from 2.5. Right? We can see some decline in pattern of liquidity. Right? So if you go to the quick asset ratio, that is previous one current ratio, now quick ratio. So how to calculate quick ratio? Quick ratio equals quick assets over current liabilities. Quick assets, it doesn't include inventory or the prepaid expenses. Here we cannot see prepaid, but we can see inventory. If we reduce inventory from our current assets, right, then the in this case quick asset, right, over current asset, quick asset is 200 minus 12 divided by current asset remain the same. Current asset, that is 200. Sorry, current asset. Okay, current liability, that is that current liability?
80.
80. Yeah, correct. Yeah, what is the answer?
2.35. 2.35.
Alright, 2.35. If you move to the year 2025, then the current assets 320, inventory 20. Divide by current liabilities. Answer is 1.8.
80.
Huh?
1.807.
80
Yes.
or 81 or something, no? Right. Then again we can see the similar type of impact in this quick ratio as well. Right? Then if you want to calculate the return, now what are the ways? Yes, we have to calculate. In this case, actually, you are given according to the previous experience, 60% of sales were credit, right? Then 40% sales were cash. Then if you want to divide this sales, right? What is the sales amount? 200. No, am I correct? 200 and 290. So in order to divide this into credit sales and the cash sales, you can use that 60% and 40%, right? 60% credit sales as mentioned here, right? You can calculate and understand it, right? That is also somewhat important, right? In some calculation. Then here, gross profit ratio we already calculated. Assets turnover ratio already calculated. Current ratio, quick ratio calculated. Not asset turnover, we calculated actually inventory turnover. Debt equity ratio, debt equity ratio, debt equity ratio, debt equity ratio. Right, so how to calculate? The debt capital, that is a loan capital, right? Long term loan. Debt means long term loan capital, right? Long term loans, right? Then over equity capital, right? Equity capital means share capital, ordinary share capital, ordinary share capital plus reserves. If you go back to the previous example, in capital, we can see owner's capital and liabilities. Capital is here. Profit means the profit under reserve. Reserve, return, earnings, profit, right? All are reserves, right? Then altogether, these two, this is the equity capital. Then long-term liability is not given. All right, here non-current liability. Here under this category, you can see non-current liability. That is bank loans. That is 210. Right? Then the debt equity ratio you can calculate. Right? The debt equity ratio is debt capital. Debt capital is loan capital, right? 210 over here owner's capital 270. Then you can obtain answer. this is for year 2024. 2025, you can see here, this one is 260 debt capital or loan capital, equity capital is 324, right? So tell me the answer, previous one. Actually, we can measure the financial risk through this ratio. This value is 0.77. Am I correct? 0.77.
Yes, sir. 6.7, sir.
Next one.
Point 80.
0.80, yeah.
It's
0.80. Right? Then here it is. This is here for year 2025. This is for year 2024. Right? Then here actually this measures the leverage. Right? If this debt equity ratio equal to 0.5, right? That is called right, not 0.5, equal to 1. This is if it is equal to 1, that is called uh, equally that we have equal amount of debt and equity, equal amount of debt and equity, right? Then if it is less than, then debt equity ratio less than 1, in this case, yeah, equity capital is higher than the debt capital. In this case also same, 0.7788 mean we can see, yeah, it is not a equal geared company, it is not a high geared company, low geared company, right? Low geared company, right? But if you go to the year 2025, it has increased by a small amount of loan, right? That's the reason. Yeah, you can see loan capital increased by a particular amount. That's the reason. Previous year 250, 210, and this year 260 by 50. Increased by 50. Right. In this way, you can calculate the debt equity ratio. Right. Then, if you want to take return on assets, then return on total assets. So, how to calculate? ROA. ROA means, so you can calculate it. What is the way? Yeah, profit before interest and tax. That means profit after tax plus tax. Yeah, profit after, if you want to take profit after tax plus, right, interest. Profit after tax plus interest over total asset, right? So profit after tax you can obtain from this statement, profit before tax, here profit 2024. Total assets. Assets, total asset, asset include non-current and current. Yes, total asset is given, right? So you can obtain here total asset in this case 560 into 100. Then you can obtain this 40 over 560 into 100. What is the answer? This is for year 2020. The 2025 also, so you can do the same thing. So if you go back to the calculation, here 150 for year 2025.
105, sir.
750. Then the profit for the year 54 plus add back the interest part also. 54 plus 6, 60 over 750 into 100. Now you can compare. The highest one is good, right? Highest ROA is better. Highest ROA is better. In this way, you can calculate major ratios: current ratio, quick ratio, inventory turnover ratio, debt equity ratio, then the return on assets, right? Debt equity ratio. So you can calculate all these things, right? So you are given number of examples. This is regarding the another questions from Professor Ranjani, right? Senior Professor Ranjani. So you can see similar type of thing. Then what are the after reading them, you should be able to understand what are the sources, right? Sources of cash flows, sources of cash and the uses of cash, right? So how to identify through this kind of chart. So you can see some examples as well, right? You can see some the role of financial management, right? There are a number of exercises to calculate the if we have a scrap value. So here it is important to know, if we have a scrap value, it should add into the cash flows of the last year, right? If we have working capital requirement, so it should be a part of initial investment, right? Right? But you can recover that part at the end of the period. Again, this should be the last year cash inflow, right? Then here in this case, initial investment is 1.5 million. Then the working capital requirement is 300,000. Then when you are calculating your cash flows, so you should careful with that. You should careful with that. Here we have a number of years here. How many years? 5 years. 5 years. Then 2, 3, 5, 6. 6 years and descriptions as well. Right? So then year 0, year 1, year 2, year 3, year 4, year 5. In this way you have to prepare the cash flows, right? Then the initial investment, you know that initial investment given as 15 lakh. Right? Then the working capital requirement 300,000. Right? Then this will be covered at the cash inflows at the last year. Right? Then the scrip value. Right? The scrip value, it would be 200,000. Scrap value means we can sell the old existing machine at the end of the project by 200,000. That is cash inflows, right? Here also cash inflow. Then in addition to that, annual cash flows, year 1, net annual cash flows after tax. So you are having cash flows here 400,000, here 450,000, 600,000, 700,000. For the last year, 800,000. Right? Then you can obtain cash flows at the end. Net cash flows after tax. This become 15 plus 3, 1.8 million. Cash outflows. Here this one 400,000. This one 450,000. This one 600,000. Sorry. Positive one. Positive, all are positive. 700,000. This one 1.3 million. Right? Then if you want to convert this into the discount, the payback period, if you want to calculate payback period, this one you can recover by using the previous table, right? Then if you want to obtain the net present value, first of all you have to convert this into discounted value, then discount factor. If it is 10%, so this one here 1, sorry, not it 12, this is 0.909. You are given, so you are given whether it is 10% or 12%, so or 15%. You have to select the relevant one, right? Relevant discount factor, right? If it is 10%, so you have to multiply this by here, 400 by here, 450,000 by here. Likewise, you can obtain answers, right? And ultimately you can take the present value of cash inflows and initial investment after comparing them. So this is given 10% discount factor of the cost of capital. Then you can calculate the NPV by getting the balance of or the net value of present value of cash inflows and the present value of cash outflows or the initial investment. Then you can compute the value here. Right. Here in this case, right. So mainly, here in this case also you should be able to create cash flows, right? After that you can do the same thing, right? Yeah. Calculate payback period, ARR. Don't go for the ARR. I hope to check. Then there are some weak points of ARR. You need to write something about the weaknesses of ARR method. But when you are calculating it, it is easy to calculate payback period, NPV, profitability index. Right? Then how to estimate this one? Initial investment is 800,000. Right? So again, you have to prepare the table. Right? Here you have to prepare a table including number of years, right? Number of years. Initial investment, you have to calculate what would be the initial investment for year 0, 1, 2, 3 and so on. Year 0 you can see as mentioned here, project with initial investment, initial cost that is 800,000. investment of here. Project involves establishing cost, that is a part of initial cost. Then establishment cost here. Establishing cost, that is 100,000. Then the required working capital is the actually capital part of that, right? 900,000. Those are cash outflows. And working capital requirement is 50,000. Working capital requirement 50,000. And the project expected generate annual cash flows after tax. Right, this is 950. And so on. Then the net annual cash flows after tax, that is 180,000 each. 180,000 each. Is the cash flows after tax, no? 180,000. Right. Actually, this should be 280,000. Please make this correction. 280. Lifetime is 4 years, no? It is given 5 years. Then the scrap value 50,000. Scrap value and working capital. Scrap value 50,000. That is the cash flows at the end of the period. Working capital requirement, it will recover at the end of the project. Right. Likewise, you can rearrange your worksheet, and this ultimately we can multiply this by discounted factors, given discount factor. And the tax rate is also given, right? So you can further adjust it. So there are a number of examples here to practice. So don't go for the IRR. So in this time, I'm not going to check it, but you have to write the merits and demerits, right? Merits and demerits. So you have to write for these three, right? No need to calculate IRR, but you have to have clear idea about the strength and weakness of each method, right? So another question here. You can expect this kind of question. So ultimately you have to evaluate them. Yeah, you can see the scrap value and the additional working capital requirement and the initial cost and the lifetime of the project. So then you have to prepare two tables to compute NPV for machine A, project A and project B. Right? Right. So here you are given another questions to practice. Right? Here to compute this kind of ratios. Right? Right. At the end, I want to highlight here. I plan to arrange 5 questions, then 25 marks each. You have to select only 4 questions out of 5. So first one regarding the here introduction to accounting and finance for manager, right? Then what is the difference between accounting and finance, right? Then the the introduction part and the introduction to finance as well. So accounting concept and accounting equation. Accounting equation, one question, right? Then financial statement ratio analysis, one question, and capital budgeting and long-term investment decision, one question. 25, 25, 25, here also 25. Then last component, finance, sources of finance. Then the risk and return. So we can see, I think you have a very basic idea given for this area. What are the sources of finance, type of financial management decision. So it also includes 25 marks. You can select 4 out of 5 questions. Out of 5 questions. Then if you want to, do you have any matters to discuss? Can you manage? Do we have enough confidence to face for the examination? Doctors? Doctors? Doctors?
Yes, sir.
Why don't you? Yeah.
Yes.
Yeah.
Sir,
Yes.
Yeah. Do you have any other things to clarify?
Give us the assignments.
yes, yes, sir.
Assignment?
Assignment, sir, for the.
Finance.
I gave you an assignment or not?
Not, sir. Not, sir.
Not yet, sir.
Not yet, sir.
Right. So then I will send the assignment document. Right. I already prepared, but I couldn't give it. Right. Then I will send that document. Then after the examination, so you will have 2-3 weeks, right, to submit it. Right? It's not a hard work. So I think up to now you have downloaded annual reports. By using the annual report, you have to obtain financial statement analytical techniques, and also you have to copy or retype the annual report and prepare the. That means you can get the screenshot of that financial statement, and you have to prepare ratios and interpret the results, right? So that is the simple assignment to be covered under this course unit, right? You are given 3 weeks, right? Within 3 weeks. So after the examination, you can do it. But I think by tomorrow itself, I can provide assignment. I will provide assignment to your coordinator, right? So I will mark it, otherwise, right? Is it okay, doctors?
Yes, sir. Give some marks for that.
Okay, sir.
Good, sir. Good, sir.
Sir, Anjani ma'am, questions also include that.
Yeah, that is the
account question
financial
5, no?
financial sources. Yeah, sources of finance. Risk and return. Then if you go to this kind of thing, right?
Yes.
Can you see that?
Yes, sir.
Yes, sir.
Right. So here you can search. I think you have a number of slides to identify this answer, no? Madam already given that slides, no? Those slides.
Yes, sir.
Yes, sir.
What are the sources of finance? What are the uses of finance? So profit maximization and shareholders wealth maximization,
Yes.
risk and return,
Yes.
right? Yeah. Actually, if you want to obtain the difference between financial management and the financial accounting, So you can see this kind of description: financial accounting and financial management in terms of purpose, right? Recording and reporting past year financial performance to external users under the purpose of financial accounting. If you go to the financial management, planning and controlling financial resources for internal decision makers, internal users, managers and workers, right? Employees. Then the prime focus on accuracy, compliance, and actually we prepare financial accounting based on the accounting historical data and then under the financial management we are preparing based on the future oriented, right? Then if we think by the governed by tax, that means this is called IFRS, International Financial Reporting Standards, right? We can see some accounting standards for preparing financial statement, but if you go to the financial management, you cannot see that kind of rigid standards, right? So key output under the financial statement, we can see the income statement or the statement of financial position or the balance sheet, cash flow statement. But under the financial management, budget, investment, appraisal, finance, the risk assessment, those are the output. So main users of financial accounting, you know that external parties like investors, creditors, and public sector, and also the internal sector, right? Internal party also concerned about the financial accounting, internal as well as external, right? So here you have to mention that internal, not only the external, internal, but financial management only for internal parties, right? Right. That is that's all, right? Do you have anything to clarify, doctors? Right. If not, right, wish you all the very best, right?
Thank you, sir.
Yes, keep well, that means read well and go through our PowerPoint slides as well. In addition to that, I attach number of previous chapters to read and practice some exercises, but it is enough to have knowledge with discussed today's discussed points, right? So with that knowledge, you can easily earn marks for higher grade, right?
Okay, sir.
Okay, all the very best.
Thank you, sir.
Right. Okay, good night.
Thank you, sir.
Thank you, sir. Thank you, sir.
Okay.
Thank you.
Thank you, sir.
Thank you, sir. Thank you.